wealth mindset. And what that comes down to is, on average, based on what the Census Bureau says in the DMV, our commuting area, the average individual will make about $3.7 million during their lifetime. And if you would just take the time to calculate how much you have already earned, just think about that. And now think about, what is your net worth? From the monies that you have made, how much do you really have as far as what you have in your retirement accounts, investment accounts, and things like that, less what you owe as far as balances on cars and balances on houses. And if you're doing that, that $3.7 million, even if it's just $3 million, you and a spouse, that's $6 million. And what I found in my practice is that a lot of individuals in our community, we have income, but we don't have wealth. And so in 2016, I left Morgan Stanley Wealth Management and started my own company so that I can educate our community on how they can take the income that they have and converting it to wealth. And that's the wealth mindset. I am a certified financial planner, a counselor, strategist, and a lot of my time is spent in, right now, doing a lot of education. Prior to going into working for Morgan Stanley, I was in the Air Force for 36 years, and that experience was in finance as well. And so in my practice, what I try to do for my clients is provide them with safe, secure, and executable solutions. Because a lot of times we can do this smoke and mirrors, but for me, numbers are numbers. If I can show you your numbers, then hopefully that's going to help you as far as your success. I focus in 3 areas, and the first is debt elimination, and I'll show you why. And then the second is life insurance protection. And then finally, retirement planning. If you have any questions at any time, please don't hesitate to ask, all right? And this is something my mother used to say all the time before even I heard about Robert Kiyosaki. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it. My mother said that to me even as a little girl, way before I heard about Robert Kiyosaki. And that's kind of to the foundation of wealth creation and wealth building, is that we can have the money, but if we're spending it as quickly as we earn it, then no, we're not going to build that wealth. So here, when we talk about life insurance policies, now there are several, but they're only in 2 categories. You have term and you have permanent. It's just as simple as that. Your term would be what you have on your job. It'll be if you get a term policy from a life insurance agent. Pretty much that's it. And then when it comes to your permanent, we have whole life, which a lot of clients come to me and all they want to do is, I want whole life. But we have whole life, we have index universal life, and we have universal life. My practice, pretty much, I spend a lot of time in whole life and index universal life. Now the reason for the index universal life is because the cash value, if you're looking for something long-term that you want to grow, especially if you're doing it with your children, it is a great way to build wealth really quickly and have it continue to grow because it's attached to the performance of the stock market without being in the stock market. Versus when we're talking about a whole life policy, it is a fixed rate, and that's all you're going to get over the life of the policy. But there are ways you can design whole life policies that you can use in a very powerful way, and that's what I'm going to show you as well. So the cash value in all of your permanent policies grow tax-free, and that's because you're paying the premiums with after-tax dollars. This, too, is one of the #1 ways wealthy people build their wealth, is through life insurance policies, because they can access it at any time for any reason without ever having to worry about the taxes. And so with that, too, you don't have to worry about withdrawal penalties that you would if it was in the stock market. You can also pass on the benefits to your children or to a charity as far as the benefits later on. And then there are living benefits that are already included in a lot of the policies that I find in our community we don't know about or we don't access, and I'm going to cover that as well. And then again, the death benefit passes to your heirs, to your charities, tax-free. Any questions so far? All right, so when we talk about life insurance, as a practice, I want to emphasize that life insurance is a want, not a need. Because in the sense of how much protection do you want for your family? How much do you want to leave generationally? So what I saw a lot in my practice, and I see still, people would put more in car insurance than they would be in their life insurance. Whereas if you're putting the money in a life insurance policy, it can be used to purchase the car. retirement, medical care, divorce settlements, and luxury items, as well as education. But I have individuals saying, all I want to do is just enough to bury me, because they don't understand the power of how you can use life insurance. And so I say it is an enhancement. And when we start thinking about life insurance as a whole across the financial community, you should have 10 times what your salary is. So if you're making $100,000 a year, you should have at least $1 million of life insurance protection. And in our area, we see the value of that because we have homes that are in the $500,000 and up. We have individuals driving luxury cars that are $50,000, $60,000, $70,000. We have children that you want to send to college without having to pay for student loans, any kind of other debts that you have. And then, too, you want to leave an inheritance to your family. So when we look at life insurance, the loss of the income from one of those income earners, husband or wife, can really devastate your family. And so even when we're looking at $1 million, it doesn't all have to be in permanent protection. What I do with my clients is I kind of stack it. So we have some that's through your company that by the time you retire, now you don't need it anymore. Your house is already paid off. So it's very inexpensive when you look at your group insurance. We may then add some term insurance on top of that because it's inexpensive, but we know that the longest term in policy that you can get is 30 years. And then we do permanent insurance. That permanent insurance will be increasing, so as you get older, you get more insurance at the same price, and then once you leave your job, you lose your insurance. Once you lose the term insurance, you still have as your permanent insurance. But in those years when you needed that high amount of insurance at a very low cost, you can still get $1 million of protection at a very low cost. So I tell individuals to look at life insurance like you would auto dealership. There's no one size fits all. And yet sometimes what I see is everybody's being trying to fit into the same mold. And so your needs may not be the same as your coworkers' needs or your sister's needs or your friend's needs. You have to tailor it, or as I said, we design it so that it fits your needs and your time horizon. So I wanted to go ahead and show this video. I hope everything works well. So to give you just a basic an overview of what we're going to cover today, and we're going to see if this works. Oh, it's up there. All right.
Really powerful concepts here when it comes to the IUL. First is the time value of money and allowing money to compound income tax free for a number of years. And here's a great illustration called $1 Million Baby. This is an actual illustration, by the way. And imagine setting up a child or a grandchild for life for the cost of a cup of coffee. And you'll see here from this presentation what a wonderful gift it could be for a parent or a grandparent to put away some money for a child and let it grow for a number of years. They could be set for the rest of their life just by doing a little bit of pre-planning, right? And there are a lot of numbers here on this page, but let me go through them and give you an idea. Now, this is just an illustration. Your numbers could vary, ages, times, contributions, and so on. But just to get an idea that if someone were to start off with, say, $25 a week for 5 years, and then $35 a week, and they were increasing it a little bit from 25 to 35, and then the last 8 years, $46 per week, for a total contribution of $28,800, and they did that until the child was 14. So if you added all this up, they put in a total of $28,800. million income tax free. Add that all up, that's $3.5 million. $3.5 million, carry that over. They also had a tax-free death benefit that went to their heirs at age 89 of $1.6 million. The total is $5.2 million. That's the total benefit, and they never paid more than $28,800. Remember, they stopped at age 14 and then 0 afterwards.
Powerful, right? That's how we are missing out when we only get life insurance for burial. Now, as you noticed in this video, he said they stopped at age 14. I took this and ran it all the way to age 65, and it was over $16 million. And that's what we're missing out when we're talking about pennies on the dollar by having a life insurance policy designed the right way, especially when you start out with an infant. And you can start out at 14 days of age. And so one of the reasons I use this video is just kind of give you an overview of how powerful it is when you're using life insurance the right way. Any questions on the video? Because I'm going to break this down a little bit more through my presentation. Any questions? Don't be afraid. All right. So one of the things that he talked about in the video was how to use life insurance and the living benefits. What I find oftentimes when in our community, we think about life insurance for burial. And when I talk to individuals in other communities, what they focus on and what a lot of the companies I work with focus on first is what happens if you become ill? Because the probability is greater that you're going to become ill before you actually pass away. And it could be an illness that maybe lasts 90 days, 120 days, and you go back to work. So the policies are designed in such a way that based on the death benefit, you can use a percentage of that death benefit to cover medical expenses. And I'll show you some of the options that are available. And then, as you saw in the video as well, nowadays, almost everyone is responsible for taking care of their own retirement planning through a TSP, a 401k, a 403b, a 457. How many of you are financial experts? Know how the stock market works, right? Most of us don't. That's not our profession. And so we're doing this with information we're getting after the fact, third party. And so as a result of that, and what I found too, is I have individuals who they're not sure how to fund their retirement, they're not putting the right investments, they're not putting enough money in. In addition, they're taking money out to pay off debt. So the policy is also designed, as you saw in the video, where you can start drawing lifetime income. And so this is the portion too, if you live too long, or in this case, outlive your retirement pension or your retirement 401k, now too, you can use the life insurance policy for retirement planning. And this is also what most wealthy people do. They don't do 401ks. They don't do TSPs. They start planning for their retirement when their children are babies. And that's what you saw in the video. By using the life insurance the right way, now you also have this guaranteed stream without Uncle Sam telling you how much you can put in, when you have to take it out, when the penalties if you don't take it out, and if you want to borrow against it. So again, they're putting a lot of money into their life insurance policies for their retirement. And then finally, death, where we're leaving an inheritance to our children or our children's children. Here are some of the living benefits that are included in the policies. So first you have your terminal illness. And on this particular company, terminal illness, life expectancy is 24 months or less. Most companies is 12 months or less. By basically, you have a $1 million policy, and you meet this criteria. Some companies is 50%, which means $500,000. Other companies is 80% or $800,000 that you can use for either your final expenses, you can use to do renovations to the home, you can have in-person people come into the home as far as caregivers, you can even use it to clear off your bucket list before you pass away. So there are no restrictions on how you use the money if you have terminal illness. We also have here then chronic illness, and you can see for chronic illnesses, if you can perform 2 of the 6 activities of daily living, that's incontinence, dressing, toileting, transferring, and it also even covers mental cognizance. So again, If you, like one of my clients, about 3 or 4 years ago, she had a horrific accident on 210, rear-ended, flipped her car 3 times. She owned her own company as a nurse, and so she was doing a lot of traveling. Well, now her income ended abruptly because of the accident. She was able to use this provision in her life insurance policy such that she was able to have funds available to cover her mortgage, to cover someone coming in and taking care of her, buying her food and everything else. That came out of her life insurance policy, not out of a disability policy, not out of an AFLAC policy. It came from her life insurance policy. We also have here critical illness, and you can see here where we talk about end-stage renal failure, we talk about ALS, AR, the graft surgery, organ replacement, strokes, cardiac arrest. When I use this for most of my clients, it's as a result of someone who has high blood pressure and they have not taken good care of themselves. And so when this oftentimes happens is when we're using this criteria as well. And then we have also in here your critical injury, which covers coma, paralysis, severe burns, and brain injury. I see that often in individuals who are not taking care of themselves because of their diabetes. And then you also see on here Alzheimer's. Now, I don't know if any of you have experienced having a family member and having to care for a family member with Alzheimer's. That could be 10 to 15 years, and then the expense associated with that. I know, like for my mother-in-law, we ended up having my sister-in-law leave her job. We paid her to take care of my mother-in-law because we just didn't trust the care that was being provided to her. That can become expensive. And when you're able to use your life insurance policy to cover those kinds of expenses, that can give you a great peace of mind. And any of these give you peace of mind now. You can choose to have better quality of service than be a victim of this is all I have, or end up, a lot of individuals call me because all they have now is they got to give up their home because a parent has to be placed into a nursing home. They've reduced everything that they have to the bare minimum, and then when they pass away, Medicaid comes in and takes the house, settles for the difference of what they owed. And a lot of individuals don't realize that with a life insurance policy, you can have these kinds of benefits. I met with a mother last week, and she had a policy on her 3 children. She purchased a policy in 2014. I was very familiar with the company that she had the policy with. And I asked her the question, I said, when was the last time you had a policy review? And she says, I've never had a policy review. I just bought the policy, and that's why I'm asking you, what should I do? I said, well, the reason I'm asking you is because the living benefits that are included on the policy you have, that company has added 5 additional benefits, and you don't have any of those listed. If you're working with your life insurance agent and they're doing your annual review, they'll bring you up to date on what's available. Even if there's a cost, what the cost is, that might be something beneficial that you might want to use. And if there's not a cost, typically all you have to do is just apply for them. But if you don't apply for them, and that's all you have on your life insurance policy, that's all you get. So it's important that you take the time to get at least an annual review, not just of your life insurance, but everything financial. So just like I tell my clients, if you're gonna have an annual review for your body, taking care of your eyes, your heart, and everything else, a physical review, go ahead and have a fiscal, F-I-S-C-A-L, a financial review. There are a lot of individuals in our area that can provide you with an annual review, and most of them will give you 30 minutes to an hour without any cost. And now you can make a decision on how you're gonna proceed, because again, no one raised their hand saying they're the financial professional. The laws change every year. And even if you just do it when you're doing your taxes, or what I just ask my clients to do, use a date that's significant to you. It might be your birthday, it might be Christmas, it might be your anniversary, some day that's significant. It could be Valentine's Day. I'm gonna love on myself, both my body and my money, right? So take the time to do it on an annual basis. Any questions? Yes, sir. Were you gonna say something?
No, ma'am, it's good information.
Now, I ask you a question
Yes, sir.
on children, insurance policy on your child, right?
Yes, sir.
So what if they have no children and they want to know themselves?
You can do the same.
You can do the same. Right. And so that grew from 0 to 14 years old.
Yes, they only contributed premiums for
Will the amount be different for 50s? The amount is the same?
There are three criteria that insurance companies use to determine the amount of the premiums being charged. The first would be the gender, male and female. Then the second would be their age is a criteria as well. And the third, which is a real critical, is their health. Those are the only three criteria companies use to determine how much they're going to charge you for the insurance. And then you're going to choose the insurance based on what your needs are or your budget is, one of those two.
If you have a chronic illness, are you still qualified for that?
It depends on what the chronic illness is. I've had where I've been able to insure individuals who've had cancer and stroke, aneurysms. It's just a matter of choosing the right company. And as I was saying earlier, you want to use life insurance companies, I kind of say almost like auto dealerships. Not everybody's going to get the Range Rover. Not everybody needs the Range Rover. Not everybody needs a Volkswagen either. So you're going to find the company and the product that fits you and your needs and still fits within your budget.
Okay.
Any other questions?
I do have, so how does it work? I mean, based off, so, I mean, the $1 million baby, but in terms of when you start with your insurance, how fast does that?
Again, it is based on how the policy is designed. As I was saying, there's no one size fits all. And so I'm going to show that to you and the various ways that I help my clients with having the policy designed the right way. So you'll hear me often say it's the way it is designed. But often when people come to me, it's like, I just want $20,000 of whole life insurance. And when I start asking the questions, well, what do you want this life insurance policy to do? And then, what do you mean? I say, do you want it to be something that you're going to leave as an inheritance? Are you looking for it to pay off debt? Are you looking for it to be able to use for your child's college education? What do you want the policy to do? And then they're kind of lost because all we think about typically is burial.
One more question.
Sure.
In terms of, like, let's say you wanted to buy property, can you use insurance as well as a means of being able to do that as well?
Yes, you can. And I'm going to show you that as well. Because I understand that a lot of you are into real estate. And so I added in this presentation how I've used life insurance policies to help clients with real estate. Because I know that's a big thing in this area as well. All right? So again, with life insurance, what I try to help our clients understand when it comes to life insurance, you can, and when it comes to wealth building, you want to, the word I use is leverage your money. You want to leverage your cash value. You don't want to liquidate. And oftentimes what we do is we liquidate. We earn money, we go buy something. Now we have to go work again to earn money to buy something. Or we take what we have, we sell it, we take the money that we made and buy something else. So that's not building your wealth, that's liquidating. You never see your value of your assets grow. And so again, and with this, you can use it as cash or you can use it as collateral. So collateral is also how you leverage the dollars that you make. You absolutely have your own choice. So as I said at the very beginning, this is not something new. This is a strategy that's been used for centuries. It just seems like it's becoming new in our community. And the reason I want to show this to you is because Walt Disney used his life insurance policy because no one believed in his dream about why would anybody come to a theme park with these characters, and so no one would invest in his dream. He used cash value, cash from his life insurance policy to start Disney World. When Roy Kroc was trying to buy McDonald's, and the brothers that owned McDonald's initially, there was a partnership, and he didn't have the funds to do that as well. He actually borrowed from his life insurance policy to buy the McDonald's brothers out, and look where he is now. with John McCain when he was trying to run against Hillary Clinton. And in Arkansas rather, he was not winning and no one would fund his campaign. He used the monies from his life insurance policy to fund his campaign to continue the presidential race when he was trying to win in Arkansas. I also listed banks because banks own a lot in life insurance protection as well. It's called bank-owned life insurance, or BOLO. I have the annual statement from Bank of America. I decided not to put it in here because I wasn't sure how much time we have. But when you look at their annual statement, in any of these companies, and it's not just banks, but all large companies like your Walmarts, your Costco's, any large company is going to own life insurance. As an employer, most of your large employers, like where I was at Morgan Stanley, all of their executives, they have a life insurance protection on their executives. It's part of the contract that you sign when you become one of their executives. If they're going to pay you a $2 million salary and they think that you're going to be there for 20 years, they're going to get a $20 million policy on you that they get to keep. And when you pass away, they get a policy that paid out so that now they're reimbursed for the salary that they paid you during those working years. But I was looking at the one for Bank of America. When you look at their spreadsheet, their balance sheet rather, they had like $20 million in real estate, dollars in other equity fund, but they had $90 million in life insurance. And that's because, again, they can take the cash value, they can use it for any buildings, construction, or any other thing that they want, and never have to worry about how it's going to impact them financially because the money is guaranteed and backed by the insurance companies. So again, it's not something new.
Could you repeat where they put the money again?
Well, for Bank of America,
Yes.
they have some of it in real estate, and they had another one in investment assets, but most of their money on their balance sheet, like over $90 billion, was in life insurance.
Okay.
Yeah. And just like you would have in the church, where your church is insuring your pastor, if you have a policy designed the right way, even for the insurance on your pastor, you can use that life insurance cash value to pay for your car, your vehicles for your church. You can pay for it for the construction of your church. Any number of things you can do because it's owned by the church, even though it's on the life of your pastor. And so we help churches who do that as well.
Next question. So you said, so they have policies on their employees.
Yes.
And so if that employee passes away, they get the benefits or the premium from it?
They're the owner of the policy and the beneficiary. They're paying the premiums. The individual works for them, and therefore when that person passes away. It's very similar. People don't realize that when you purchase a home and they ask you to get mortgage insurance, and it's owned by the mortgage company, and it's designed that if you default on the home, they're going to get that, even though, let's say, you have a $500,000 home, and let's say that you pass away and there's $250,000 that you owe on the home. Then the mortgage company is going to take that $250,000, pay off the home. What do you think they're going to do with the other $250,000? They keep it. Yeah, even though you pay the premiums, they keep it because the owners of the policy. And so we encourage individuals when they purchase their home, get the insurance on yourselves. Get the insurance that is protecting you and your family. So if you have a $250,000 balance, your family could, although I don't recommend it, pay the $250,000, pay the mortgage off, and they get to keep the other $250,000. But we do it because that's kind of what we do. Because all right. So now I want to just talk about debt. And the reason I want to talk about debt is because it consumes so much of the monies that we make. Most individuals don't realize the highest debt that we have comes from our mortgages, our credit cards, and student loans. And that's because interest is compounding every day, every day. And I hear on the radio all the time, I listen to 104.1, and there you'll find several companies that deal with mortgage refis. And they're constantly encouraging individuals it's time to refinance. And so what is the benefit to them of you refinancing your home? Now you're going to restart that clock. They get all of that cash because you refinanced your home. And in essence, you're saving maybe, what, $100 a month, you think? but you also now kicked yourself into a higher interest rate by restarting your home. It troubles me when I have individuals come to me, and I'm working with a couple right now. She's 66, he's 73, and they refinanced their home for 30 years.
Wow.
It's very common. And I say to them, I said, how long have you been in your home? 44 years. And it's so common. I said, so you realize what you now have done is basically you're renting your home from the bank. Because again, most of the children are not going to take over the home. And because you're not going to pay it off before you pass away, you basically have now rented your home from the lender. And I teach a class just on refinancing, but this is very, very common. So again, how you pay for things can really impact your ability to create wealth. I used to teach the Dave Ramsey course. I did it for years. And the get out of debt or their debt snowball process. And it works for a period of time, but it only works for a short period of time. And what I did was I was praying and said, Lord, we've got to find a way that we can get individuals to eliminate their debt and make it successful for them. They can see the results of them, but they can be successful. And so in 2018, I found an organization out of St. Augustine, Florida, and they have a program. Theirs is called Your Family Bank. You may see them on YouTube and on television. Our organization calls it a get out of debt, or GOOD, G-O-O-D, get out of debt. This was one of the first couples that I used this program with. This individual, we've changed their names. He worked for me when I was in the military. And his wife and he said that our goal is to get out of debt in at least 10 years so that we can retire. We don't want to have any debt. If you can show us a way to do that with the money we already have, sign us up. And I said, not a problem. So in this case, you can see for him, and this is the algorithm that we use, and Brother Jeffrey talked a little bit about this. Again, their goal was to get out of debt in 10 years. So when you refinance a debt, what is that process? Anyone can tell me. When you refinance, kind of like what you refinance your house, what are you doing?
Restarting.
You're restarting. When you're doing a consolidation, what are you doing? Okay, you're restarting, but you're restarting differently, right?
Yeah.
When you do a settlement, what are you doing? You're taking a $1,000 debt, you're settling for $500, right? And all of those impact your credit score. It impacts the, what I'm seeing as we're consolidating these debts, what people don't do is now you've been paying $500 a month, and now you're going to consolidate them that you can pay $300 a month because you stretched it out over a longer period of time. And instead of doing the continually with the $500, they're going to do the $300. And statistics show that within 3 years, they're going to be in more debt than they were before they did the debt consolidation. Because we have not addressed the habits that caused you to get in debt in the first place. And so with this program, as I work with my clients, we address how did you get there? And now how are we going to get out of this without having to impact your credit score by doing consolidations and settlements and things like that. The other thing that you have when you do debt consolidation or debt settlement is it doesn't usually include all of your debt. It's usually consumer debt, like your credit cards. But as you can see with our program, we include everything. So it's your cars, it's your credit cards, it's your student loans, it could be your taxes and medical bills. It also includes your homes. And I'm surprised how many people think, well, okay, I don't have any debt except my house. So they'll look at their home as a debt, when really your home is one of your most expensive debts. Because typically if you go in a 30-year mortgage, by the time you've paid it off, you've paid 3 times what you actually had because of the interest alone. So in this case with Joe and Karen, our algorithm just shows them, we calculate then who you owe, how much you owe, and the interest rate that you owe on the debt. And what it calculates is, you can see here, they had credit cards, they had auto loans, they had home equity lines of credits, because one of the things that they had been doing, borrowing from the home to pay off debt, only to get in debt again. And so their total debt was over $787,000. And what most people don't think about when it comes to their debt is the interest. The interest that they're paying on the debt, nor do they really know when that debt is going to be So in their case, their interest was $380,000. So this is saying this is your current debt, this is your total debt, almost $1.1 million. And then two, what our algorithm shows then is when will that debt be paid off? And a lot of times we know when our car is going to be paid off, we know when our home is going to be paid off, but pretty much not anything else. So I want to just show you why companies are encouraging individuals to use their products and get in debt. Now you see that PayPal has credit cards, SoFi has credit cards, everybody and his brother has credit cards because wouldn't you like to earn this kind of interest on a daily basis? When we look at just the first line, JCPenney's, where the interest rate is 26.99%, the payment is $53, but $33 of that goes to the interest. And that's just on day one when they send you the credit report, the bill. So if you are actually purchasing during that time period, now you may have a $500 balance. You end up charging another $100. That $100 is now $600 before you even pay the bill, and so that interest is accruing. And so individuals then, I'm going to pay the interest, I'm going to pay $50 more, I'm going to pay $5 more, or $10 more, and in essence, that interest and that extra payment is already gone before it even gets to the company because of the interest that's accrued between the time you made your payment and the purchases you made since. And so it is very, very profitable for individual companies, and they encourage you to get in debt and stay in debt because it's profitable to them. And what we've seen over time, it used to be for your outstanding balance, it was anywhere from 2.5% to 3% that you had to pay as your minimum payment. That number has dropped to 1.5% to 1%. Why? Lower payment, more interest for the companies. And yet a lot of us feel like they're doing us a favor. No, they're not. They're not looking at your interest because they're looking at you as a consumer and a commodity that they can count on. Any questions? All right, so this is Joe and Karen. I wanted to show them. We took all of the funds that they paid extra. That's all we did at restructuring their debt elimination plan. And we used that money to purchase a life insurance policy on Karen. And the reason we did that was Karen did not have any permanent life insurance. And so by just moving the money from paying this extra to these companies, and as you saw, it was going to take them 22 years, 6 months to get out of debt, by moving that money into a life insurance policy for Karen, and then turning back around and using the cash value in the life insurance policy to pay off debt, we were able to get them out of debt in 8 years, 1 month. Same money, just more efficient way to use the dollars. And because they went through COVID for 2 years and didn't travel a lot, they actually accelerated this and were out of debt in 6 years. And that included their home. So now they're in a position to take the monies from the cash value, investing in Airbnb, other businesses because they're totally free and they're still working. Right? This is a summary of what we were able to do for them. And just can you imagine that? I said, what is the average income for the persons in the DMV according to the Census Bureau? What was that? $3.7 million. And here you can see, just by paying these debts off, we put $2.8 million back in their pocket. A lot of us, we don't see it because we're just accustomed to paying the bills. We work, we pay the bills, we work, we pay the bills. And this is building real wealth. Real wealth. Any questions? So that's just one way of building, of using your life insurance. And the reason I do the debt elimination first is because we do want to free up these dollars so that now our clients can do more with the money that they have.
Well, I wanted to go back to in terms of debt elimination.
Mm-hmm.
So when you were working with that client, they were using the overages that they would normally pay and put it into the life insurance policy?
Mm-hmm.
Okay. And in terms of when did they actually start really addressing, I guess, paying off their debt? Like, how long did it take for them?
As you can see here, this tells you when they're gonna pay off the debt. JCPenney was the first month. That next credit card was the second month. Let me get my cursor here. This tells you when they started paying off debt. So you can see here, go back here. Check that where it is. Oh, right over here. 1 month, 2 months, 3 months, 5 months, 9 months, 11 months. Right here tells you when they're paying off each of those debts.
Okay.
Because what we do, once the life insurance policy is approved, we then do an integration of the cash value of the life insurance into the policy, and it would tell you exactly what month and year each of those debts are gonna be paid off. And that's what I was saying. Typically, people don't know when they're gonna have that debt paid off. The integration that we do, this is the software that we use. And again, it's all dependent on the design of the policy. And I'm gonna show you some how we did it powerfully when it comes to real estate. But with them, we just did kind of a very straightforward, this is how much you're paying in extra on these on these debts that you're paying. Let's just take all of that money together, kind of like what you do with the debt snowball. But instead of paying down one debt after the other, we're gonna take that money and we're gonna put it into a life insurance policy. And so how many of you are familiar with what they call a balance transfer on credit?
Yes.
It's basically doing a balance transfer. So instead of when there's enough cash value in the policy, we're gonna pay off JCPenney's using the cash value, and then we're gonna turn right back around. The money that we were paying to JCPenney's, we're gonna use that and pay off the loan to the insurance company.
I see.
And we do that over and over again because the value of using cash value and borrowing is you never deplete your cash. It continues to grow. Whereas if you were doing this, say, for a retirement plan, you actually take the money out when you borrow, your balance goes down, now you gotta pay it back, build it back up before you could do it again. When you're using cash value for loans, that money is being used over and over again, growing over and over again because the insurance company is loaning you their money, and it's a private loan between you and the insurance company. So as a result, our clients' credit balances start going up because now the interest you're paying to the insurance company is compounded only once a year, whereas when we're doing credit card debt, mortgage debt, that interest is compounding every day. So very, very powerful.
So you can put anything in this, like houses, cars, credit cards, just anything.
Anything.
And then you're not paying extra. How do you get extra? So the extra comes when you pay off, or when I pay off on a credit card, then I take that amount, put it on the next.
I'm having trouble seeing this and seeing
Okay.
this at the same time. Okay. So what you'll see here, like we're paying off the JC 470. They started out with 1,400. From the life insurance company, paid off JCPenney's. The $53 that they were paying JCPenney. All right, does that answer your question?
I think so.
So this is our roadmap. I call this my one pager. So I tell my clients, we're gonna take this one page, put it somewhere that's really significant that you can see in private, and this is gonna help you know and stay motivated to get that debt paid off. And you know it's guaranteed because it's telling you what month and year each of those debts are gonna be paid off. And so what happens a lot for our clients is they start seeing the progress and they get to the point where they want to accelerate it. Oh, I don't need to go out to lunch as much as I did because now I see what it's costing me. And that's the process that I go through with my clients. I understand how to make this work successfully. Another question?
So when does the cash value become accessible to start the process of that?
For this company, it's specifically designed to help middle America get out of debt. So the cash is available 10 days after you make your first premium payment. That's why this couple was able to make their first debt payment the first month.
No, that's good. You said 10 days after the.
10 days. That's because this is specifically designed for debt elimination. Again, how is the policy designed? What is the goal?
Got it.
So this policy is designed for debt elimination.
Okay.
Any other questions?
Now, the Facebook thing, we're talking about the breaches of the, TransUnion and all of those people, the TransUnion, Experian, and all those people. How does that, would that be something you would, try to get that off first, or, well, I don't have a lot of that, it's enough. To see if I can get that off my credit before even going through this process, or just go on ahead and just start paying, get into that insurance company and design it where I'll start paying the stuff, things off.
What I do as an individual, what's in your best interest
Okay.
and how to make it work. So again, there's no one size fits all. And so I look at everything that you have in order to make that recommendation to you. Okay? Any other questions?
So in, while she mentioned credit, so in doing it this way, does that increase your credit? As far as Experian, TransUnion, and.
No, this is gonna increase your credit score.
Your credit score.
Because you're gonna be paying off debt quicker.
Your credit score, yes.
But this has no correlation as far as we're not integrating with any of the credit reporting bureaus at all.
But it increases your credit score.
It will increase your credit score because you're eliminating debt without doing a refinance or consolidation. And again, too, one of the other benefits is that when you're doing a consolidation, typically you're paying somebody a fee to do that, and there's no fees or costs to you for this. So more of your money is going towards what your real goal is, and we're not replacing one debt. Okay, all right. So in this case, you saw where they was using it for retirement planning. And I said that a lot of our wealthy clients don't use your 401ks, your TSPs, and 403bs for their retirement. This was one of my younger clients. She worked at Capitol Police. She was fully funding her TSP, but she wasn't quite sure if she was going to continue to stay with the TSP or anything like that. And so as we were discussing her options just for life insurance protection, she mentioned that she already purchased her luxury vehicle, and now the insurance she had was a federal insurance or FEGLI. And I said, this is the ideal time for you to do a consolidation of the two. You can get life insurance protection, and you can do retirement planning, and you can also have monies for your down payment on your home instead of borrowing from your TSP. And so this is exactly what we did. She was fully funding her TSP at $20,500 a year. You can see she started out then with $824,249 of life insurance protection. You can see where the arrow was pointed at the $55,000. That was going to be the money she was going to use for the down payment on her home, because she was projecting 3 years that she was going to purchase her home. Now she has the option here. As you saw in the video, they were taking money out, which I don't recommend, because over time, it's going to grow. Right? You want to take and build it up, but she has that option. So we have this $55K available to her to use as a down payment. And then in retirement, and she said, oh, I think I'll work until and not need anything until my 70s. You'll see she's getting a guaranteed retirement check, tax-free, of over $333,000 a year. Now note here, she has put into the policy for 41 years, $944,500. In the first 3 years, as far as her retirement money, she draws out more than she actually put into the policy. That's the power of compounding as well. But throughout, she has all of this in her cash value that she could have used along the way if she got married, if she had kids, if she wanted to help her grandkids. All of that is still hers to be used, even if she wanted to just use it for a vacation. If she was using all of this in her TSP, she would not have this kind of flexibility. Any questions? Okay. This is another client. This individual, where she worked, did not provide her with a retirement account. So she was funding her own retirement. Plus, she was putting an extra $1,000 a month to pay off her home. Her goal was to pay the house in 10 years. So I asked her, well, are you going to keep this home during, over the next years as far as putting all of this extra money in it? Now, I ask those questions because as you're putting extra payments into a home, that's a hard asset. How do you get money out of a home if you need cash? Refi, what else?
Home equity.
Home equity line of credit, right? Because now you put everything in here and it's a hard asset, and if you have to go back and borrow, first you have to qualify, and then you're gonna borrow, and then you still have to pay it back. So I was sharing with her, by putting the money into her life insurance policy, first by adding this extra $1,000, first she gets not more in life insurance protection. But secondly, when she's looking to pay off her home in 10 years, we determined that it